Doctor, I would love to become an expert at Forex trading. I had the absolute pleasure of speaking with Dr. Anders Ericssonn, the expert on experts, the eminent scholar and professor of psychology and the author of the exemplary book Peak, Secrets of the New Science of Expertise. Together with Mark Chapman, a great trader and mentor, we discussed when we could call ourselves successful or expert traders, and is this in fact a measurable outcome? Are we experts when we've reached our specific monetary goal, or are we expert traders when our equity curve is sloping upward for more than 45 degrees? Does our strategy need to perform with a good win to loss percentage for a long period, like a week, a month, or a year? How many trades do we need to take? Are we expert traders when we can withstand a heavy drawdown period in our trading without breaking a sweat? There are so many variables to consider. Enjoy the video. Let me know what you guys think in the comments below. Okay, do you see the screen now and the mouse moving on the screen?
Yes.
Okay, so for me, first of all, thanks Mark for that introduction, and it's fairly accurate. Been trading for a while now, about 5 years or so, not being very profitable, and just needed a few tips, I think, from you, and then things started turning around very quickly after that. So thank you for that, Mark. The process is what Dr. Ericssonn is after, I think. Yeah, so I'm just going to go over what the process is for me. So step number 1 is, there's you can either buy or sell to money in this market, in the Forex market. So it's not like the stock market really, when you're an investor in the stock market, all you want is to see the prices going up after you've bought. And not many are successful doing the shorting the market. But it's completely different for us here in the Forex market. I'll show you what the process is for me. So the first step is it's a daily routine, is trying to find out which of these currency pairs are going to move, which ones has the best potential for a move, because we can't make money if it's not going up or down. It has to go somewhere. So which way do I trade, and which of these pairs am I going to trade? So the first step is going to something like the Forex Factory. It has your currency pairs here and the potential for the move based on news events that are scheduled. So if we look at the week here, so Monday would come in, and then I would know there's a potential for the dollar to move at 4 p.m.
So there's economic data scheduled a week in advance every week, Dr. Ericssonn, for every major currency, essentially, or country. So whether that's US job numbers, US GDP, Australian GDP, Australian interest rates, it's already published a week in advance, and what the forecast is and what the previous was, and then obviously you get the actual figure.
Okay.
Yeah, so it gives you an idea of a currency that might have some volatility to move, and nobody knows in which direction it's going. I don't know. So if Doctor, if you hear for some sort of a forecast that's in the wrong place. So what I can tell you for a fact, is that we having non-farm payrolls tomorrow, and my time, that's 2:30. So there's a potential for a big move in the dollar and the dollar major pairs like the dollar versus the cable, the dollar versus the CAD. So I know that's going to move. So that's as far as the predictions go. But which way it's going, I don't know. The thing is that what I do know beforehand is that I would only trade that thing short. I would only sell the euro versus the dollar. I'm jumping over to Friday because you want to know what's going to happen tomorrow, right? So
Right.
Yeah, tomorrow this market is going to move. It's not going to be there anymore. Yeah, it's going to be based on statistical evidence. Really, that thing could move between 70 and 140 pips, and that's based on research and statistical evidence of of years and years. And what I also know is that it's been in declining. The amount of volatility that this non-farm payroll has is smaller, irrespective of the differential here. We look at this figure here, yeah, the 180 versus 263. This is all on any forex calendar about tells you what the forecast is and what the previous one was. So we know that beforehand. What we don't know is what's going to happen here.
So you see that, Dr. Ericssonn, where you had a really good jobs number out the US last month, which was 263,000 jobs it added. Mm-hmm. So this forecast is expected to be worse. And yesterday or the day before, there's a precursor number called the ADP jobs number, which is usually it gives you a sense of what the actual jobs number is going to be, and it was dreadful. I don't know if you've got it there, Russ.
No,
it's okay. It doesn't matter. So it must have been last week, but it was a terrible number. So the fact that it's suggesting that the forecast is a lot worse. Actually, there's now this pre-outcome sentiment that already exists. So previous month was high, this month expected to be low. The precursor data is terrible, so it's definitely expected to be low. Imagine then if it comes out a lot higher than that 180 figure.
Okay.
Yeah.
So it's essentially it's going to wrong foot sentiment, which is going to create the bigger, essentially more volatility, the bigger move. So it would net be positive, the greenback, and fundamentally. So this is like short-term sentiment stuff, but this is a big deal in terms of fundamentals, jobs and inflation being the two biggest numbers. So. So tomorrow, if Rustem, if fundamentally we want to be buying dollars because it's got the biggest interest rate differential over any other Western country, tomorrow, if this shocks and is positive, the greenback will want to get long dollars against a weaker currency, right?
Mm-hmm.
So, for instance, what's a weaker currency? Well, the Australian central banks just come out and said that they've been saying they were going to cut rates and they've cut interest rates, right? So therefore, the dollar against the Australian dollar is probably a good pair to focus on because you've got they've got that differential between the two central banks.
Yeah.
So to what extent has that information already been taking into account?
Priced in. Yeah, it's a good question. It's never priced. It's never really baked in when it's a surprise. Right, so as we were just saying there, the actual number's supposed to be bad. So that gets baked into the price because the greenback all week's been poor. Because the forecast is poor. Right, so that absolutely is what you've just said. That gets baked into the price. But if it's a surprise, then therein lies the opportunity.
So to what extent would somebody who had a lot of money be able to collect information that would provide a reasonably good guess here as to what the employment numbers would be? Because conceivably they could go out and collect that information, right?
Yeah, it's for everyone to read, but none of us know the outcomes. So it's a question of What's the fundamental picture? Where's inflation? Where's jobs? And what's happening with the interest rate? They're the core fundamental drivers of any currency. Right, okay, so the US is on a rate hiking cycle. And as we just said, the Australian economy, central bank, is on a rate cut, has started cutting rates. Right, so you go towards that, but none of us know what the outcome will be tomorrow. We can just make an inference that the forecast is poor, the precursor data has been poor, so everyone thinks it's poor, so that bakes in all week the greenback's been struggling, but tomorrow it might have an absolute resurgence if that job number comes in at, say, 250,000 positive. We won't know that until it does.
So if you guys now had to make basically a judgment here, how would you approach this decision tomorrow?
So we would mark up areas on the chart where we'd want to get long dollars. We want to buy dollars. So I don't know if you want to take over, Rustam, from there.
Okay, so we don't have the number out yet. Yeah, this is an unknown year.
Right.
What is known is the weaker currencies, like what Mark has just been talking about. The Australian dollar is weak for fundamentally, based on a number of reasons, and then also to add a cherry on the top. In this very week, the previous interest rate was 1.5, and they've dropped it. Yeah, so basically we know that it's gone even weaker now, fundamentally and sentimentally. So we know this is weak. So that's the given. And we know the dollar is strong fundamentally, based on your various reasons, and then the unknown is what we're waiting on for tomorrow. But that's just the thing. We are not trading this based on just that figure. It's this is just going to be a sentiment thing. A sentiment is at the time what the guys are doing right there and then. Yeah. So tomorrow at 2:30 my time, we know this is going to move either way based on that figure. The thing is that this is the chart here that I have. Let me just
got the Aussie dollar.
Do you want to do the Aussie dollar?
Yeah, use the Aussie dollar and just pick some levels up and.
Okay, 1 second. Let's just do it here. So if we look at, we don't even need to look at any fundamentals here. If you look at the left part of the screen here, and where prices are right now at the bottom here, you can see what's been going on. It's been selling off the Australian dollar versus the United States dollar on a weekly basis since the 21st of January here. It's been going down. So for me, irrespective of what happens tomorrow, I won't buy in on a weak figure on the non-farm payroll tomorrow. If there's if there's a bad number for the United States dollar, this is what the plan would be for me. Yeah, something like this. A bad number should cause sentiment in the market, pushing price up into that level, because people are now selling their dollars versus Australian dollar based on that news. But because of my fundamental view, which has been in place since January 2018, irrespective of the news tomorrow, I am not a buyer of this pair.
So he's essentially what he's saying is he's going to be buying greenbacks irrespective of the number, and if the number's poor, it's only going to serve to bring the dollar to him more cheaply, because he's doing it against a weaker fundamental currency, i.e. the Australian dollar.
So I'm a little bit of a novice here. So when you're saying about buying, what kind of money do you have as a way of, providing money for supporting these transactions?
Yeah, it's just whatever your account is, however much you're trading with, right? Everyone's obviously, yeah, it's just you can fund your account to any degree.
But basically, would that enter into the picture as well here? Where you actually do have your money currently, or
No, it's because it's just you're just picking on a price chart where you want to do business, because there's technically some reasons why or where you should be. So if you want to draw a horizontal line across them.
So in a sense here, what you're saying here, okay, tomorrow buy US dollars.
Potentially buy US dollars, yeah, absolutely.
Right. Okay, and then basically, so where are you now making the profit? At which point are you selling in order to actually realize any kind of gains?
Yeah, so you want to explain that?
Yeah, okay. Let me explain that part quickly. So at the moment, if you look at the price on the far right-hand side of the screen, that price is quoted. It costs 0.69 cents to buy $1 Australian. Or at the moment, it's 0.6981 cents to buy $1 Australian. At the moment. So if the number is good tomorrow, for the dollar, then the consensus is that prices are going to go down here, which means that then, like, this gray line here is where prices are right now, and this little blue line that I've got here is where we might expect prices to go.
Okay.
So 0.69. So if prices comes down to, this is 0.69, and then it's called pips, the increments, the decimal points here, 0.6981. So the amount from the pip value from there to here is about 60 pips. So for you, the value of one pip depends on how much money you risk. So if you're trading one pip equals to $1, then in that case you would be making $60. However, if you're trading one standard lot, then one pip is equal to $10. Yes. So that would be what, $600. So it all depends on your account size, and it depends on your risk appetite. So this is a whole new ball game, The risk part of this is I'm not sure if we.
So this kind. So I just want, maybe you want to just try and clear it up for you. It's there's kind of like different sections to trading. There's the technical element to it, which is what Rustam's laying out in terms of like that trend line and these areas where you want to buy and sell. That's the technical side of it. The fundamental side of it is the news, and the sentiment side of it is the news. But there's also the risk management side of it, and there's also the psychology of being able to actually handle being in a trade that is maybe perhaps going against you, or is even going your way. You will have these visceral lizard brain responses that make you want to, like, oh, I've just made $600. I want to take that money right now. Or versus like, oh my God, I'm losing like 10 grand. What am I going to do? Kind of like that type of thing. So there's different areas that you've got to master. It's not just like, oh, this is trading. There's very definite different elements to trading that you've got to actually ultimately master. So what Rustam's talking about here is if you're risking say 30 pips, and let's say that equates to $300, you're going to have to try and go for twice that at least in the upside, because If not, you're going to have a really high win percentage to actually cover your commissions and all of that. But there's another part to what Rustam, I guess, is about to say, is about being able to run a part of the position as well, which allows you to not really care what price ends up doing. You're just going to try and wring its neck as long as you possibly can. We're trying to give you a crash course.
Yeah, a crash course. Wow. Yeah. Like I said earlier on, if you like in January 2018, or this one year's in December, we saw prices are coming down. It's on a downward sloping trend. So if you calculate like a pip value, then from that point all the way down to this point is 500 pips. So you know, if you had one standard lot there, then that's $5,000. So it all depends. This is a question that I had for you, Doctor. It's about like, I mean, I can make one pip equal to whatever value I want that pip to be, depending on my risk appetite. So would that then make me an expert? Because I'm making much more money because one pip is valued more than someone else. You know, like if I traded all the way from here all the way down to here, and I was correct all the way for months, for a whole year, I was trading this short. But one pip value for me was only $1 per pip, which means I made $500. But then someone else, he trades it up here, and in one day, his one pip was equal to 3 standard lots or whatever, and he made $10,000 with that small little move here. You know, is he a better of a trader? You know, I don't know how to measure like this type of game or this. I doubt whether you can do it as in monetary terms or.
So could I just get a clarification here? So you're basically in some ways capitalizing on the fact that when bad news comes, it's going to take a while for the actual price to reach kind of its lowest point. So you're kind of capitalizing on the fact that you can get in earlier in anticipation for that change, and that's how you basically get an advantage. Is that?
Yeah, and when we're taking the trade, we're actually trying to take advantage of. We want to be selling, say, in this scenario, i.e., buying dollars. We want to be selling in this scenario when our opponents, i.e., whoever is buying Australian dollars and not US dollars, is actually in trouble. So you first of all have to come up with the idea that you want to be short the Australian dollar. The reason we want to be short the Australian dollar is because the US has a 2.5% interest rate. Inflation's pretty good. There is talk of them cutting the interest rate. I don't currently buy it yet on the current data, but regardless, if you just think of if you and I were going to go and open a bank account tomorrow, and we had two banks to choose from, one that was offering us a 2.5% rate of return, and the Australian dollar that was offering us a 0.25 rate of return, and they've just dropped their interest rate, so they're actually going the wrong way, and the Fed are actually going the opposite way, and the rate's higher. Where are you going to put your money? You're going to put your money in the higher rate of return, right? So fundamentally, we want to be selling Aussie dollars, buying US dollars. So that's our first thing. It's to generate that idea. Right, cool. So that's a thing. That's a real thing. You're going to have those capital flows coming into the greenback. Great. Okay. Technically, where we're going to do business. So you then look at areas on a chart where price had historically actually moved from previously, whether it be up or down, right? So you mark up on the chart where potentially there's an area where you might want to sell off. So do you want to just get a zone there? Yeah, put that zone there. See that?
Mm-hmm.
So you see how it bounced up before and then respected it and then went below it and respected it and then went down and then it's come back up to it. That's essentially a technical level where traders are buying and selling off. Cool. So that's where we want to do business, but we don't want to be too predictable. We don't want to just be that obvious, because otherwise we might get manipulated in that scenario and be right, but actually shaking out the trade. So now what we want to do is we want to go down into the lower time frames and look for people buying the Australian dollar and wrongly being sucked into doing so that we can then fade their move and take money from them, because they've totally made a wrong decision. But technically it looked like the Aussie dollar was strengthening against the US, but you've absolutely missed the fundamental backdrop, which is why we can be confident that we want to sell Aussie dollars and buy US dollars.
Yeah. So, Doctor, like if you have a look here, this is now a 15-minute chart. So, which means every candlestick is worth 15 minutes. So, for the next candle to open, we need 15 minutes. Yeah. So,
Okay.
that's what
It's a lot quicker. This.
A lot quicker. Yeah. So, and the chart that we were on, this one, is a daily chart, which means every single candlestick takes 24 hours for the next one to open.
So we zoom in to get a bit more detail and to actually manage our entry.
Yeah. So what I like of the strategy that's been developed and tested is that we have the view that the bigger picture is what the bigger players are looking at. The daily charts, the ones the longer term, the bigger picture, the big guys are looking at this. So which means that these are the areas on the daily chart where there might be some sort of action. You know, there might be some sort of manipulation in this next areas.
Yeah, so we're not bothered about the minutiae that happens in between. We're looking at these key levels where there's think of them as like a decision point. Yeah. So if the trend is to continue down, these levels are going to have to be respected.
So, sorry, Mark.
Yeah, no, go for it. Yeah.
So this little gray line here is where prices are right now. Yeah, this is the live chart right now. So if you have the idea that you want prices, you won't trade anything unless you see prices getting up to this level. Yeah, you're not going to touch the chart. Then you're already right in one of your predictions without any risk. So if you were right that prices are going to get up to this level, then when it gets there, or if it gets there, you feel very confident that something could happen at that area because you were right. It moved from there to there. So the confidence starts building, yeah? And when it drops, if it drops from here, you just jump to the next chart. I mean, you ignore this one because you were wrong. You know, prices didn't go up to the level that you expected.
So just show Dr. Ericssonn what an entry would be on the 15-minute.
Okay, so if we look at where prices are, as I said, this is 1 day, yeah?
Yeah, I should just caveat this as well, Dr. Ericssonn. The higher time compressions, think of this like a Swiss watch, the inner workings of a Swiss watch. The lower compressions are working within the higher time frame compressions. So they all work kind of hand in hand. You've got to think of it like that. They're not these separate things. So we're looking to maybe sell off this daily level. We want to then go down onto a low compression and get the detail and look for clues of selling. Okay. Which is going to then allow us to take a trade.
So if we look at this candlestick here, it's called a candlestick chart. So if you look at this current candle and then the previous one, that was yesterday, and then this one was the previous day. So this was today, Wednesday, that's Wednesday. This is Tuesday's candlestick over here. Yeah. So so if we drop down to the lower time frames and notice this blue line, yeah, or this highlighted area. Now we've highlighted this area beforehand. Yeah. We've noted that it's been price has respected this area in the past, as you can see here on the 5th of March. and then it's respected it again on the 24th of April, yeah, and it's been playing around this important area for a while now. And then we carry this line through, and then we see what happens in this week.
So technically, that level should mean we'd see some selling at that level should it return. So this is how we can give that future prediction on what we want to do.
So I mean that seems like you're now making a prediction that where you could be wrong.
Yes.
So basically, if there isn't, a substantial amount of selling at that point, that would then, I guess, feed back to you and say, hey, what's going on here? And would you be able to kind of, sort of, as we were talking here, without actually having to make the purchases, try to, make predictions about when selling is going to happen or under what conditions, if the kind of the price is going to certain regions, then you basically are making the prediction of selling. So that would generate, a lot more data points where, you either are making a correct prediction or not. And I guess you also have to make it clear here what it means, how much selling do you really need for it to basically be selling as opposed to somewhere in between a lot and not so much.
So that's kind of like see, these are the things I obsess over, and it's so difficult to so we have this zone where on the higher time compression, and fundamentally we think that the price is going to react to the downside. Okay, cool. So, but we don't know if it will, and we don't know. We just making our best guess because historically that's kind of happened, right? It comes to the level, and it's like, right, we now have to look for clues that confirm our buy. See, so it's like then we're looking for clues. So it's like, okay, what's the clues? And it's like it can be numerous, which is why it's so difficult to like bottom this stuff out. Like it drives me nuts, but it's like it's chart patterns. It's a certain amount of chart patterns. How many is it? I honestly can't tell you. But once you see it, you kind of know it, and it's like at that point, then you should have edge, and you pull the trigger, and it either makes money or it doesn't. Right? That's the point of edge. You just have to act, irrespective of outcomes. You've just got to act and then move forward. So I don't know if you want to add to that, Rustin, but it's like this is what I struggle with.
Okay, the thing is that if the Zoom thing expires, then I'm going to send you guys another link. Yeah. Okay. So this is the area over here on the daily that we wanted to take action on.
That's superimposed on our 15-minute time frame now.
Yeah. So this is exactly the area that we've predicted. And the only thing we've predicted is that we said if prices gets here, we will look for something in particular before we start selling. So in this area, there are things that I look for. When that thing happens, I trade and I take action irrespective of what the news is saying.
And outcome, irrespective.
And the outcome. It doesn't matter what happens. I don't care if, the prices has been going up here all the time. Everybody's jumping in and buying. This is what you call an uptrend. Prices are going, making higher highs and higher lows. Yeah, it's constantly making an uptrend. Yeah, so it's going in one direction, and all the traders are seeing that, and especially retail traders are also noticing that. So in the face of all that buying, I'm looking to sell. The reasons is because prices are heading into the area of importance that I've predicted a few weeks ago, and or not predicted really, that I don't like using the word in trading. Yeah, prices has come up to a level that I've assumed was an important one, and it gets there. I'm looking for a specific signal, and that signal is a strategy that can be tested. That particular signal inside of a level can be tested. How many times does that signal work, and how many times does it fail? Now, if it works more than it fails, then you're making money. And that's all that I'm interested in this game. I'm not interested in whether I was right or wrong. I know that this works a certain percentage over the times that it loses.
Yeah. And we get the opportunity to manipulate the R, because we get to manipulate the return, because if Rustam risks, say, $300 on a trade, he's naturally going to go for 600 as a minimum in profit, irrespective if it gets there or not. That's he has that power, and he will stand true to that. Let's say it hits the 600, he then may take not all of the trade off and leave a portion running, so it either continues, a lot further, thus increasing that R, distorting that R figure, or it doesn't. But ultimately, his risk is out of the trade, and he's made a multiple of R. So he's net he's made money. So now his break-even point, if he continued to do that over, say, 100 events, is 35. He doesn't have to be profitable that often to ultimately make money.
Yeah.
Right. And I guess, what I think would be an interesting issue is, by looking at the cases, would you be able to increase now the percentage of times that you're accurate by identifying particular configurations here that you would basically exclude here from applying this pattern or whatever? And I guess the question is, do they exist? And obviously, if you're looking for them, you would have to assume that they exist. But ultimately, it's the future outcome that's going to determine here whether, you're finding something that is accurate, or you're just capitalizing on chance.
Yeah.
Yeah. The thing is that, Doctor, if I know that I have a 65% chance of this thing, let me show you a typical entry of mine. That this is in the area, and this is a typical area. And it's based on, Mark would know what I'm talking about here. The entry would be there aggressively. So if we find ourselves and prices are here, and then another qualifier would have to come into play. As prices are here, it would need to come through this and then break down. It would need to come from above and break down. So a whole lot of things has to work before you start risking anything. So when the trade is triggered, you already feel confident that it's going to, play out as per your 65% statistic over the amount of years or whatever you've been trading.
Testing it.
But would you be able to look back and see here, what percentage you are in applying these patterns, whether they were successful?
Yeah.
Are you saying 65%? That's just a guess, or
no.
No. But he's also the complicating factor, as always, right? But the complicating factor is, so let's say technically Rustam's back tested that ad nauseum, get 65% positive expectation from that pattern. It doesn't take into account fundamentals. Right, so if you just go back through 50 years worth of chart history, it doesn't tell you that the Fed was cutting interest rates. The chart is just the chart, right? So the problem you've got is Rustam wouldn't take a trade counter to this if the fundamentals didn't line up.
Yeah.
So that's what makes it so difficult to try and quantify it. So technically it works, and technically there's edge, or seemingly so, but we just don't want to take technicals. We want to be trading with those fundamental drivers. But you cannot Well, I'm unaware of. I've never seen a model that you Dr. Ericssonn did nuclear physics, so maybe he could think of something. But I don't know how you could then add into the fundamental drivers and those news events that happen every single day that are diarized. I don't know how you would add that.
Is that before you make a decision, whether it actually involves buying something or just sort of theoretically saying that you would buy something, it would seem like you would need to explicate what those kind of additional fundamentals would be that led you either to decide to do it. And I think in some ways probably would be useful to have cases here where it was similar, but you decided not to go ahead, and then basically being able now to examine here what happened. And
Yeah.
Right, that's so interesting. So what you're saying is define out what that fundamental bias is just completely, and then be able to then just apply that to every scenario.
well, it seems to me that at least when you were talking about that fundamentals of the differences in interest rates between Australia and United States, that you could kind of explicate that in this sort of predicted trend. So I guess the question then would be, once you go through cases, will you be able to explicate how this now translates into something that, you at least could graphically illustrate as reference lines or whatever?
Got it. And what's your take, Doctor? Because obviously we're running out of time, so I want to listen to you now. It's like, what's your take on those technical aspects where there are those variances where you have multiple touches of a certain structure, you have a certain depth to that structure, the manipulation is different, the entry point is different. You can have a playbook for all that as a human, but is in your opinion, is there any way of, because to me on the face of it, it always seemed too complex to try and model that?
I think the first step would be just to explicate what it is that you're seeing. And I guess it might actually be quite interesting if the two of you were to look at the same graphs and then independently kind of work out, decisions here about when you theoretically would buy, because obviously you don't have to coordinate this and do actual purchases. Because it seems to me that if you're making commitment here to either buying or not buying, you can now analyze what happened with the prices to assess here, whether in fact you were making an accurate prediction, and and how valuable basically a potential actual purchase would have been.
Right. So what you're saying is almost take away the emotional element to it and the financial element to it, and then just look at it objectively and try and then understand what the profit potential would be from that scenario.
Right. And I think that, once you can explicate it so somebody else would be able to read a description, I think that would be a really interesting question here. To what extent would they be able to replicate your results? But I think it would be really important then for you to start collecting results, so you have enough kind of instances that one would be able to kind of start asking questions about statistical differences.
Okay. So in terms of, from your perspective, Doctor, a statistically significant figure would be what?
Well, basically, and again, I think we have to find sort of what alternative model would be, maybe what other people would be doing, or some kind of very simple method. When they started, I guess, with the weather, they just used the base rate, and I don't know. I could imagine that in certain markets where things are trending, then obviously you shouldn't assume 50%, because basically, you're going to have a trend here that leads to certain kinds of differences.
Differences, right? But in terms of like a statistically significant sample size, what would you say that figure is?
I think that entirely has to do with how you explicate now, and basically what it is that you're trying to predict. Are you trying to predict just whether you would make a gain, or are you trying to predict how much gain you're going to make? Or basically, one just has to be very explicit here about what data you're trying to predict. And once you know that, you would probably know what statistical model you could use. And then the question is relating that now to your respective predictions. And in particular would be, I think, interesting to see here how well aligned the two of you were. And maybe that would be interesting even to you to kind of see here whether you actually will have differences in opinion, at least in some cases.
Got it. And would you say that's in the hundreds or thousands? Usually, I mean.
Well, I would say, we're talking hundreds.
Okay.
And it may be that even less than that if you have, a more informative dependent variable than, correct or incorrect. But if you were to use correct and incorrect, and again, it has to do a little bit with how big of a difference are you actually expecting? Because if that difference between what you're doing and chance, if that is, maybe 8%, that's going to be much harder to detect than if the difference is 30%.
Got it. That's so cool. And is there anything I'm just like love having you on this call, and I could speak to you forever, but just in terms of like, I'm so trying to get my training material to what you would consider like that, somebody to be able to follow that process and to be ultimately get to mastery. Have you got any tips on like how you make that process as simple as possible? And do you have any, like, do you understand any time scales, like what that is usually that has previously been boiled down to, or is it completely case by case and you've just got to get into the absolute bones of things?
I guess one of the things that makes this a little bit different from some of the other cases is that they would maybe, present now a screen which would be, AKG or, basically some medical image or something. And then, you have to diagnose it, which is essentially what you're trying to do. You're trying to predict what's going to happen, which is a little bit different maybe from identifying something that's abnormal. But in essence, I think, you could apply the same methodology. It's just that, there might be differences in the appropriate models that you would be using. But I could send you a couple of papers from medicine, and if I'll think a little bit more about, whether I know of any kind of efforts here to kind of good examples here of kind of forecasting issues where people have been not obviously when it comes to currency trading, but in other cases trying to predict events. And maybe that would be a good starting point. And then, we could maybe get in touch here and see if, especially if there's questions here that, are relatively short, I probably could answer them by email, or, we could schedule another meeting perhaps.
Brilliant. Oh, thank you. We keep trying. We keep trying. Thank you very much, Doctor.
Well, I think this is really exciting, and hopefully here I can be helpful here, so you can, explicate this and maybe help people here, being financially successful here. So I think that's really interesting, and maybe if we just kind of, I'm going to have to leave now.
Yeah.
But it was, I really enjoyed talking to both of you, and wish you good luck. And may take me a week or so before I can get back to you with those papers.
Oh, no, super cool. Thanks so much for your time. Rustam, I'm sure you'd like to thank the doctor.
Yeah, thank you very much, Doctor. Yeah, I'm a statistics guy, and I believe that somehow we need to be able to, calculate this.
Bottom this thing out. So
Yeah.
Thank you very much for your time.
Thank you.
Okay, well, it was great talking to you guys, and we'll stay in touch.
Yeah, great. Thanks,
Okay.
Dr. Ericsson. Take care. Have a great day.
Cheers.
Okay.
Bye-bye.
Bye.
Bye. Bye-bye now. Bye-bye.